Being able to calculate the intrinsic value of a company is the most valuable skill that an investor can have. You can run the most in-depth, complex business analysis on a company to determine that it would make a great investment, but if you can't determine a safe entry price for that same company, it can lead you to making devastating long-term investment decisions. A great example of that is if you look at Microsoft during the 2000 tech bubble. If you had purchased Microsoft stock at any time in 1999, you wouldn't have seen a return on that investment for over 13 years. Now, Microsoft is undeniably an excellent company and an excellent long-term investment, but during the 2000 tech bubble, the stock price ran away from its fundamentals, and it would have led you to making a devastating investment decision if you weren't using a reliable valuation technique. That is why in this video, I'm going to be covering 4 of the most popular valuation methods, and for each one, I'm going to be listing the strengths, the weaknesses, and when to use them. In addition to that, I'm going to be using Facebook as an example for each of these valuation methods so that you can see the difference in intrinsic value that is produced by all 4 of these methods. Hopefully by the end, you will have an idea of which valuation techniques you should be using for certain companies and also which ones might fit your investment strategy the best. What's up everybody? Welcome back to my channel where I give you simplified, rational investment analysis so that you can make an informed investment decision. My name is Aaron and I hope you guys enjoy this video and learn something new. So with that, let's get right into the 4 valuation methods we're going to be looking at today. And I'm going to start by looking at the least reliable valuation method and working my way up to the most reliable. And now, when I'm talking about reliability, what I'm referring to is the amount of assumptions that have to go into that model. Generally, the more assumptions that you make, the less reliable that valuation method is going to be. So for that reason, I'm ranking these by the number of assumptions that are going into that model. However, you'll see that just because one valuation method isn't as reliable as another, doesn't mean that one of the less reliable ones shouldn't be used over one of the more reliable ones. And you'll see in which situations that applies as we go over all 4 of these methods. So the first valuation method we're going to take a look at, which is the least reliable, is relative valuations. This is where you take the company you're looking at and you compare its multiples like the price to earnings, price to sales, or price to book to that of its industry peers or to that of the entire market. What this gives you an idea of is if the market is pricing the company you're looking at more favorably or less favorably than that of an average stock in the market or that of its industry peers. The strengths of this valuation method is that it gives you a great idea of how pessimistic or optimistic the market is on whatever company you're valuing. The weakness, however, is that it doesn't provide you with any sort of insight on what a solid entry price might be for that stock. And the reason why is because the entire market or an entire industry can be overvalued. So even though its price to earnings might be lower than that of the market or of that of its industry peers, it might still be overvalued in terms of making a long-term investment decision. So for that reason, when you're using relative valuations, generally you're going to be using it for shorter term swings, or when you're using some sort of a paired trade strategy where you buy a company with the lower PE and short the one with the higher PE, assuming that eventually their multiples will revert to the mean and you'll benefit from a directionless trade. However, you should never be using relative valuations when you're making a long-term investment decision because it provides you with absolutely no insight on what the intrinsic value is of the company. Now, when we take a look at Facebook, we see that their price to earnings is trading right around the average of that of its competitors and industry peers. However, it's trading well below the price to book and price to sale averages of its industry peers. So from looking at this, you can say that Facebook is fairly valued compared to that of its industry peers. However, this does not tell us anything about what a solid entry price would be for Facebook. Now moving forward, we're going to take a look at the third most reliable valuation method, which is the discounted cash flow model. Now what the discounted cash flow model attempts to do is predict what the future earnings of the company will be in order to find the future cash flow of the company, discount it back to today's value, and through this you're going to determine what the company's value is today. Now the strengths of this model are that you can use it for virtually any company in the stock market. And you can even apply it to an unprofitable company that has prospects for becoming profitable in the future. So this gives anybody using a discounted cash flow model a lot of flexibility in being able to apply it to any stock that they're looking to value. In addition to that, it's the most commonly used valuation method, so you'll be able to compare your valuation to that of other people who are also using discounted cash flow models. The weaknesses of this model, however, are that it requires a large number of assumptions. You have to be making assumptions about the future growth of the company, and you also have to be making assumptions about the future operational results of the company. This is one of the hardest things that you can do as an investor, and naturally it leads a lot of people to making mistakes, which is why you have to be very careful when you're running a discounted cash flow model that you're inputting the right values, as it can drastically change the results of your valuation. And this is exactly why generally when you're using a discounted cash flow model, you want to generate a low scenario and a high scenario in order to find a range within which you think that the stock is fairly valued. Now, when you want to be using the discounted cash flow model is honestly for any company in the market. However, given that it provides you with a range rather than a definitive intrinsic value to the company, I don't find it as reliable as the next two valuation methods we want to take a look at. However, it is still a very useful valuation method that you can apply to virtually any company in the stock market. Now, when we take a look at the high and low scenario for Facebook, we see that the low scenario provides us with an intrinsic value of $137 per share, while the high scenario provides us with an intrinsic value of $167 per share. Now, this is with the range within which you would probably be looking to buy the stock. However, it's completely up to you where within that range you believe is a good time to purchase a stock. Now, if any of you want to be using the same discounted cash flow models I am using, or for that matter, any of the valuation methods that I'm using in this video, I provided a spreadsheet that I use, which contains all of the valuation methods you're going to see in this video in my Facebook group, which you can find the link to down below. Now, if you've enjoyed this video up until now, hit that like and subscribe button so that you won't miss out on all of my new weekly videos. Now, moving forward, we're going to look at the second most reliable valuation method, and that is the earnings power value model. The earnings power value model seeks to find the value of a company's earnings as they are today. Unlike the discounted cash flow model, which is a forward-looking model, the earnings power value model takes the historical operating profit of a company and it uses that in order to determine what the value of the company's earnings are today. So the strengths that come with the earnings power value model are that it is the most reliable measure of a company's earnings. And the reason why is because they use a historical approach to finding the value of the company's earnings rather than attempting to predict what the future growth of the company will be. And another strength of this model is that it is applicable to any company that has been profitable for 5 to 10 years. And the reason why you need the company to be profitable is because you need that operational history in order to generate a reasonable estimate of what the company's earnings are worth. Now, some weaknesses to this model are that it doesn't account for growth. So for that reason, this model is going to be providing a very conservative estimate for what the intrinsic value of a company is going to be. And if that company is high growth, for example, a stock like Facebook that we're looking at today, it's going to be providing you with a far too conservative estimate at what the intrinsic value of the company is. So that is one serious constraint to using this valuation method. So when you want to be using the earnings power value model is when you're valuing any company that isn't a high growth company. So you want to be using this valuation method in order to value any stable company's earnings so that you can determine what the intrinsic value of that company is. Now, when we take a look at Facebook's intrinsic value as calculated by the earnings power value model, we see that we get an intrinsic value of $123 per share. Now, this is lower than even that of the low scenario of the discounted cash flow, which shows you just how big of an impact not accounting for growth has on this model. However, not many companies are like Facebook or are high growth companies. So for any companies who are going to be experiencing moderate growth in the future, this is a very useful model to be using for them in order to find their intrinsic value. Now, if you're interested in learning how to use an earnings power value model, I have a video under the free lessons playlist on my channel for any of you who are interested. And additionally, there's a lot of free resources out on the internet, either through YouTube or Google, that you can find that are going to teach you how to use an earnings power value model. So now moving forward, we're going to look at the net asset value model, which is the most reliable valuation technique out of the four that we're looking at today. What the net asset value model seeks to do is find the replacement value of a company's balance sheet. And the way that it achieves this is that it converts the company's balance sheet from accounting values over to market values. And now this model requires the least amount of assumptions, as most of the conversions from accounting to market values are fairly mechanical. So for that reason, there isn't very much room for error by the person who is running the valuation. So this way you're able to generate very consistent results when you're using a net asset value model. And some of the strengths are that it's relatively easy to find the net asset value of a company. After you've gotten comfortable with the technique and using the model, it usually takes around 25 to 30 minutes to find the net asset value of a company. And as we said, it requires the fewest amount of assumptions. So for that reason, it's the most reliable out of all of the valuation methods we're looking at today. However, one of the weaknesses to this model is that it tells you absolutely nothing about the company's earnings or operational results. So for that reason, it provides you with a fairly limited view of what the company's value is. And that's why a lot of value investors actually use net asset value and earnings power value together in order to find the intrinsic value of a company. Now, if you're interested in the process of combining the net asset value and earnings power value models together, you can find the link to that video in the description down below. Now, if we take a look at the intrinsic value that the net asset value model provided us for Facebook, we see that it's $56.93. Now, given that Facebook is currently trading above $200, we see how conservative of an estimate the net asset value model provides us with. And for this reason, it's not going to be providing you with a very excellent entry opportunity for Facebook, given that it doesn't account for how strong the company's earnings are. Now, as I did in this video, you can also use all 4 valuation methods in order to determine what you believe is the best entry price for whatever stock you are purchasing. For me, when it comes to Facebook, I will most likely rely on the discounted cash flow models that I created because those take into account the future growth of the company, whereas the earnings power value and net asset value are a little bit too conservative for a company like Facebook. So that does it for this video. I hope you guys learned something new and enjoyed this video, and I look forward to making my next video for you guys. Have a great week.